But then, like I mentioned, what happens to the crude oil market and what happens to Nigeria's crude oil exports and earnings will be a risk to factor in, going forward.
Okay. When this hits the system, in terms of how banks, PFAs, mutual funds, and others, those of you who have portfolios attached to the treasury bills as part of your component, how will you react to this development?
I would say that is a bit undecided as of now, because, like I mentioned, the plan for refinancing is a very good fiscal plan, but it might not extend completely to monetary policy, because lowering interest rates in the economy, the central bank seems to have much more policy instruments to effect that than the federal government. So even if the federal government, reducing their borrowings from the treasury bills market, the central bank will just come up and increase their home auction, and then they take out all the money back. So essentially, how it's going to affect the yield curve or the level of private sector lending by commercial banks depends on what the central bank's response is, right? If they decided that we still have to maintain the cost of policy tightening, then all they need to do is just ramp up on OMO bills issuance and offset the additional liquidity to come from the refinancing of federal government treasury bills obligation. So we believe that for this plan to work in terms of reducing the interest rates in the economy and allowing for more private sector lending, the federal government needs to work with the Central Bank of Nigeria to ensure that they have an harmonized view on this topic.
Harmonized view on this particular topic. But again, treasury bills, whether it comes in all this, it seems to be just a financial markets conversation. So most likely I'm going to have a few folks asking questions. How do this trickle down into the real economy? This is just looks like helping you guys downtown make more money.
It might appear so, but how would affect the common on the streets also depends on how the central bank responds. If you go... Private sector lending over the past 2 years, it has been restricted in real terms. If we remove the currency devaluation impacts on private sector lending, it's been sort of muted in the past 3 years due to elevated risk in the economy, so which has made banks a little bit less aggressive in terms of giving out loans to people. But of course, if federal government reduces their level of borrowing in treasury bills market, it will mean that there is much more money available for banks to lend to the private sector, both individuals, businesses, etc. And that could spur growth further in the economy. But the central bank has to be taken into consideration when trying to factor in the implication for the financial market, because they have much more policy tools which they can use to affect the yield curve and interest rate level in the economy than the fiscal guys can do. So if the central bank, if the federal government eventually succeeds in this plan, because it's going to the National Assembly and they have to approve of it. But if they're able to approve of it and in the end are able to do that refinancing, central bank could still, alter the impact on the financial markets by just increasing the volume of mop-ups in the economy. So it has to be a very joint effort by both the central bank and the Federal Ministry of Finance to ensure that the impacts of this actually felt by the common on the streets in terms of lower borrowing costs.
In terms of who will be part of the new game? The usual guys? Well, banks and PFAs and all that invest in treasury bills. This refinancing and repackaging, who are the guys I need to keep my eyes on?
Probably commercial banks and the PFAs. Because if you look at the half-year earnings trickling in for most commercial banks now, you will see that it is a loss driven by higher interest income, particularly coming from treasury bills. Zenith Bank's results came out yesterday, their half-year numbers, and you saw that their gross earnings jumped by over 70%. And a major factor that led to that, improvement in gross earnings was because of the interest income being earned on treasury bills. It's doubled from about 25 billion naira in half-year 2016 to over 50 billion naira in half-year 2017. So if this plan goes ahead and the federal government reduces their level of borrowing in the treasury bills market, right, and lower their borrowing cost, there will be a consequential impact on the yield on assets, of commercial banks and of PFAs. But in the end, that may probably spur them to actually look for opportunities in the real sector and extend credits there in order to ensure that their yield on assets still remains at the current level. So it could be a benefit to the main street, that is to the economy, to the real sector in general, although it could be a drag on the financial markets.
In particular, the banks?
Particularly the banks, exactly.
Particularly because you're taking a bit of their low-hanging fruits away from them.
Correct. Perhaps if you look at the asset distribution over the last 2 years, most have been increasing on their allocation to investment securities and be cutting down on real growth in loans. Last year we saw loans grow, but that was majorly due to the depreciation of the currency. Because banks have about 30% of their loans in foreign currency. So when the naira weakens, there will be a nominal growth in loans. But if you're looking at the numbers in real terms, they've actually been cutting down on their lending to the real sector and been, channeling the money to the low-hanging fruits present in the financial market, mainly treasury bills. So if there is a reversal in this, it will have an impact on their earnings going forward. But that could also perhaps spur them to take more interest in the real sector, by giving out money to businesses and individuals.
So technically, it's a good one here. Is it anything of this nature likely to happen in the bond market?
Yeah, perhaps so, and maybe not so, because the instrument the federal government is targeting right now is mainly treasury bills. And if you look at the yield curve at the moment, you will see that we have elevated yields at the short end of the yield curve, mainly for treasury bills, while bond yields are a bit lower. But seeing bond yield, on average trending between 16% to 16.5% over the past 2 years. But treasury bills yield have been a lot higher because of the aggressive stance of the central bank in the treasury bills, in the homo market particularly, through their frequent homo mop, which has been squeezing liquidity in the financial markets. So perhaps we might not see a significant impact in the bond market for now.
It's going to be quiet. Thank you, Omotola Abimbola. Thanks for putting your analyst team perspective into that.
My pleasure.
You have a great weekend.
Yes, sir.
And next week we'll have a lot more to discuss from Afrinvest investment analyst Omotola Abimbola.